I guess in the interest of moving along, we should probably get started in the last two panels for the day. First panel is the Search for Yield. Moderator is Arthur Baird. He's the founding editor of Journal of Investment Strategies, which concentrates on quantitative investment strategies, derivatives modeling, and portfolio and risk management. Arthur is also the founder and CEO of General Quantitative LLC. Within that firm, the GQ Asset Management Division concentrates on systematic volatility-driven strategies. The GQ Analytics Division is an institutional advisory service concentrating in portfolio and tail risk. Earlier in his career, Arthur was the head of macro volatility strategies at Capital Fund Management and has also held senior positions in strategy and research at Blue Mountain Capital Management, Lehman Brothers, and Goldman Sachs Asset Management.
Thank you very much. I don't know if the mic is on. It is a pleasure to be here discussing this important topic at the inaugural Investment and Trading Trading and Investment Risk Conference. I would like to introduce the panel, or rather I would ask the panel to introduce themselves. We have a very diverse and diverse in terms of their views and in terms of their focus panel of senior experts from industry. We have Kirill Levinsky, Anton Wouters, Judith Bosnikov, and Michael Hunsler, and I would ask them to introduce them.
I'm Kirill Levinsky. I run Fusion Asset Management in London. We specialize on protective strategies and hedge advisory.
My name is Anton Wouters. I'm head of customized solutions within BNP Paribas Investment Partners. This is focusing mainly on pension funds, I'd say liability-driven investments, fiduciary management, and within that department, we're focusing on several kind of strategies, including protection strategies, but also including the straightforward. So dynamic allocation processes to help pension funds improve funding ratios.
My name is Judy Bosnikov, and I'm a managing director and one of the founders of Pacific Alternative Asset Management, PAMCO, which is a multi-billion-dollar fund of funds. We build portfolios, primarily custom portfolios, of hedge funds for large institutional investors, primarily pension plans in the U.S.
I'm Michael Hunsler. I'm with Asenagon. Asenagon is a medium-sized asset manager. We are focusing on non-benchmark strategies, meaning total return. And my background is actually both in asset management and also in banking, where I was responsible for credit risk strategy and bank credit portfolio management.
Thank you very much. So the topic of the discussion panel is the search for yield. So it makes sense to start off by defining what we, I guess, mean by yield. That word certainly is used by a lot of people, but it might mean different things for different people. Perhaps everybody can chip in that. Maybe let's start this way. Yeah.
I think when you say yield, you sort of assume it's a long-term thing. And as we just heard from the previous speaker, it's about harvesting systematic risk premium. So if there are factors where there is risk premium, then you're harvesting it in some way. So now, are you doing it through buying and holding forever, or you doing it by actively managing your position, potentially doing something where on the surface there is no carry, like slide and credit default swaps or slide and quick futures. But at the end of the day, it's a utilization of systemic risk factors and systemic risk premiums.
Yeah, for me, is yield, because I'm, of course, as a manager working a lot with pension funds, is also a question of relative yield. Because I think that the topic that we will discuss later in the discussion is are yields low or not? And then my question is always, okay, low against what? Because if you invest against a liability benchmark that is being valued by the same low yields, then perhaps yields are okay. If you are an absolute return investor and inflation is extremely high, you might think that your yield is high, but in fact your real yield is pretty low. So I'm always trying to look from a relative point of view. I agree that if you look to that kind of definition, it's still about risk premium, but then relative risk premium. So in that sense, you try to get an additional return or additional benefit from investing in certain asset classes relative to what you try to beat. So that's the thing that I like to see as a definition of yield.
When we think about yield, it's actually broader than just sort of interest payments, dividend payments, the carry, and so forth. We also have to think about price changes. So it's really more thinking about return rather than yield by itself. And what we do is we look to see where we can find it, where opportunities are. I mean, three or 4 years ago, it may have been in the mortgage market. That's basically gone. You know, then you search for where you can find it in other places. So that's basically how we look at yield.
Well, I cannot agree more to it, but if you look at fixed income market these days, my impression is that most of investors are looking at it in a different way. Especially, you know, the flood of new issues which is coming to the market shows that, you know, the definition of yield for most investors is more kind of a running yield. This is the only explanation to me why, you know, at these depressed levels, you know, investors have such an appetite for 10-year and longer maturities, because, you know, if you just look at the impact of rising yields, you know, that could easily erase the returns for a couple of years only for a blip in rising rates. So from that perspective, you know, the difference between running yield and the expected return couldn't be larger than today.
Very good. So now that we know that there are different, or maybe they are all different definitions of yield, but there is a lot of commonality in what people actually want to interpret them as. The next natural question is, okay, so where do we find that, quote unquote? Obviously, since we have a discussion panel, we are not only looking at fixed income, so where can we source yield? What are different asset classes? What are different markets, or maybe strategies? Any comments on that? In which order? I guess. Why don't you start?
Yeah, I start.
Yeah.
Yeah, I think that, as I said, for me, yield is something different than only absolute yield. But we have to admit, of course, that if you look to the bond markets, that rates are low, and rates have even been lower, but in the US slightly going up. But if you look to the European markets, in fact, to the Bund, I think that they are still very, very low. So there are also different in markets. And if you then look to what people are currently looking for in this environment, because we talk about an environment of low inflation, moderate growth expectations, corporates are healthy. So what we see is that people are trying to grab some yield, additional yield, by simply going or buying liquidity. And you can buy liquidity in the pure credit space, so you will move up in the credit curve, and definitely people will talk more about that. But you can also look into other liquidity premium giving assets like private equity and infrastructure and loans, big loans. So we see, I think, that move into, if you purely look on attracting yield, that's definitely something that you see happen in institutional investors at the moment. Another idea is indeed investing, if you want to have cash flows, is investing in high dividend equity. To be frank, we don't see at the moment a very big move, at least for the bigger pension funds and institutional investors, from bonds to equity, because bond yields are seen to be low. That's not the case. Might be that there are some other reasons than only the moderate growth scenario that we have. There are also, for example, I think regulators that force investors to stay where they are to some extent. So it's a combination of that. I think that still there is a possibility in fixed income markets to at least get some additional yield. But also I think that everybody is sitting still and hope that nothing happens. And then finally, for pension funds, that market-to-market liability actually is not a bad thing if rates would go up. The other thing is you should not fully hedge it. But if you simply run a bond portfolio and you have a duration of 20 in your liabilities and rates over the curve go up, I think that a lot of pension funds would welcome that.
Can I have a follow-up question on that, especially because you are offering investment solutions to the likes of pension funds and insurance companies and such. We have seen that movie before. Would potentially packaging these other ways of reaching out for yield in a way that looks more like fixed income be a solution? Again, I'm not necessarily saying that that's the right solution because again, we have seen that in the 2000s and not all of those packages have worked out really nicely.
Yeah.
Having said it, you know, if you crash a car, it's not necessarily the fault of the car, but maybe of the driver. So
I have nothing against packaging, but I do have a very strong preference for transparency. And as long as you can package something with the same transparency, if you not package it, that's fine. But I think that the basic thing is that you need to realize whatever happens that you are investing in illiquidity.
Yes.
And that whatever happens and the market goes against you like in 2008, then illiquid assets are, let's say, are not easy to get rid of, and actually they can hurt you a lot. So you have to realize that, packaged or not.
Yes.
I don't know how it's for you, but for me it sounded a little bit complicated. Because really, at the end of the day, there are relatively few systematic things where there is risk premium. It's equity risk premium, forward risk premium, credit risk premium, variance risk premium. And ultimately, we're supposed to decompose everything into these 4 or 5 factors. And then there is liquidity, obviously, premium, and then there is tail premium. If we're clear on what actually making money and what's relatively overpriced, that's the way to pursue it. And I absolutely agree with Anton that it's very important to be transparent on that. So packaging probably not going to help understanding what actually drives your returns in this sense. So I think it's better to, in terms of implementation, you will give a manager, as soon as you decide which factor you want to go for or what's a combination, you give a manager ability to express his expertise and deliver this additional little bit on top of this systematic factor. But at the end of the day, for yourself, you need to be very transparent in terms of what you actually buying.
I'd just add a little bit to actually what both Anton and Kirill said, particularly what Anton said. What's interesting that I see is that we're sort of already seeing people go out on the liquidity spectrum, and at least in the sort of alternative space that we look at, they're trying to search for yield through the liquidity premium. And they're looking at that space between hedge funds and private equity. The problem is that they're trying to substitute sort of normal fixed income for that illiquidity, and that's not going to end well in most cases for them, for exactly the reasons that were earlier stated. The other way they're searching for it is through leverage. You know, levering up the low yields or the low returns that are expected there in an unlevered version. And again, that usually doesn't end well either. So it is a problem for large institutions on how they will get yield into their portfolio as rates begin to rise.